All right. Good afternoon, everybody. We're joined now at 1:30 with Vince Lanci. Vince is the CEO of Echo Bay Partners. You've heard him regularly in the morning the past few weeks talking with Larry about the markets and the overnight recap. But I wanted Vince to join us to learn more about Vince, the way he looks at the markets, his background, and the way he looks at gold. And so, Vince, welcome.
Thanks for having me, Mike. I appreciate it.
Yeah, it's great to have you. And this time, it's not going to be Larry, so you'll have the mic all to yourself. And so, tell us a little bit about your background, and then let's get into gold after that.
Well, I appreciate that, but I'd be better off listening to Larry than listening to myself. Um, I got my start. Right now I'm trading directionally, but my roots are in options. I got my start at Cooper Neff. I was schooled in options volatility, that market direction and fundamentals don't care about probabilities, and almost lost my net worth when Fibro cornered the silver market in '94 and then later in '97. Since then, I became a student of arbitrage and using volatility as a directional indicator. And then I started trading at a fund, a macro fund. Currently, basically, I retired in 2008 and saw an opportunity in precious metals. Passive funds had obviated their need with ETFs, but active trading is coming back, and I think the perception of the gold market has changed so that there is opportunity, not just as a safe haven, but as a trading vehicle. And as a result, I have a couple clients that I'm advising sub-strategies on, and those trades are being put up on Opportunistic Trader.
So take us through that. So how do you actually analyze the markets?
Okay. Well, first of all, this applies to any market, I think, because since we're talking from a volatility basis, if you're looking at, I'm not a technician, but I will listen to technicians when I'm looking for levels. But if a market has just had a big move, and you look at a market, say, it doesn't matter the time frame, but let's just pick a daily chart. If you look at the 20-day historical volatility, right, this is part of the system, and then you look at the 5-day historical volatility, doesn't matter the market. When the 5-day historical volatility gets to be less than 50% of the 20-day historical volatility, you will start to see the market flatline. And I call that coiling. Then there's a couple proprietary indicators related to implied volatility as they relate to historical or realized volatility. Once those are triggered, then we're ready to trade and prices are generated. Doesn't really matter what we're trading. We're actually trading volatility as an asset class, not the market itself. It works best in gold and oil. So once the H-vol oscillator is in place, once the implied volatility indicators line up where they should, and it varies from market to market, we then go to the thing that's most visual, and that would be the Bollinger Band, so people can see that. And it's very simple. When the Bollinger Bands widen in opposite directions, after these other triggers have been put on our radar, when Bollinger Bands widen in the opposite direction, you go with the trend of the market, and you use the stop out level at the midline. It's that simple. Does it say if the Bollinger Bands widen and the market goes up that we're necessarily going up? No. What it's saying is the market volatility has inhaled and it's ready to exhale. Once that market goes higher, we're going to get on, and we're trading momentum in that respect. So this is a trend following system. The thing about it, though, is it's not predicting trend, it's predicting volatility. So if you're stopped out, that's actually an indication to reverse. So the system gives 2 bites at the apple. I'm not saying we always take 2 bites, but the system does give 2 bites. It works on daily, hourly, weekly, and monthly, depending on your patience. But it's a volatility-based system, and it was created to hedge gamma in my options market making days. But it's turned out to be a pretty good directional indicator.
So do you apply this to other markets as well? Theoretically?
Yes. The first market I applied it to was actually oil, and it does best in oil historically. But it depends on your time frame. So oil, if you look at oil, say versus gold, and I think people should understand this, both markets respect the technical numbers. Oil does it faster and more efficiently. You can use this system on a 30-minute or hourly chart in oil, and you'll be basically right half the time, and you'll make 2 when you're right, and you'll lose 1 when you're wrong, and it will take 3 bars to 5 bars. It started in oil, actually, for oil gamma hedging. I used it in natural gas, and then when I brought it over to gold, I found, and this is a comment on gold, that it was not working because I was using a 2.0 standard deviation on the Bollinger Band setup. And that's because gold does kind of have a managed feel to it, capped rallies, that type of stuff. So I dropped the standard deviations to 1.5 and started using, and I can't emphasize this enough because I just really learned it, constant volume bars. And now the gold system is humming, actually. So I've used it in many markets. It operates best in energy and precious metals.
And so what time frame is this sort of trade taken in?
Well, this vector system, we'll call it, that's what I call it. It's technically a momentum system as opposed to a regression to the mean system. The time frames that it works in are all. And by that, I mean, I got a weekly sell signal in gold. Okay. So let's say you're a top down guy, a macro guy, right? But we're looking at a weekly. That's my quote macro. All right. I got a sell signal in gold in May on the weekly system, and it got us short, got the client short, and we took some money out, but I stopped the client out on a daily reversal. So it's kind of like a swing trading indicator. Had I been more patient, the $10 profit would have been 30 or 40. That was my error. But if you want to use it top down, you can trade it on a weekly or a monthly system, but you have to hold it for 3 to 5 bars. You're going to be in there for 3 to 5 bars if you're right. You're going to be in there for 1 to 3 bars if you're wrong. If it's monthly, that's 1 to 3 months. That's a lot of time. If it's weekly, it's 1 to 3 weeks. You know, what's your patience? In gold, it works best on the weekly. Do you have the patience? Well, if you're a trader like myself and you're an active trader, the answer is no, because there's lower lying fruit out there, and you want to be right or out as soon as you can. So I go with shorter time frames. Does that make sense?
Yeah, absolutely. And so, because you mentioned this is a longer term thing, it's, you're talking about trends, which are typically a bit longer term.
Right.
And so, I guess it sets up a few times a year that you see these sort of setups. And so is there anything right now that's generating these sort of setups? Any markets that you're scanning?
Yeah. Well, this is all right. Silver and gold, right? So on the weekly in May, we got a sell signal. Okay. And that thing has just been orderly and a monster. And we're not even talking about other markets like copper. I just focused on gold because it's the most continuous in terms of liquidity. And what ended up happening was the gold market gave the sell signal. And this month, now the monthly is on the radar for a move. It doesn't mean I'm not triggered yet for a monthly. But if the monthly were to trigger, and this is where the options part comes in, does that mean we're at the bottom of this and we're going to have a reversal higher, or does that mean we're going to have an acceleration on the monthly? And frankly, what I would like to do now, just speaking purely options, simply speaking, if I get a trigger on the monthly, I'd like to buy gold straddles. My preference in a more complex situation to play the skew is to buy a hedged put spread, because I think oftentimes after you've had a protracted move on this system, on the weekly, as well as constant reaffirmations on the hourly and daily, when you get to the monthly, you got to be careful. That could be the bottom of the move. And I am not saying it's not going to go lower, but I'm not going to sell a monthly signal when I want to day trade around a position that might be bullish. So I would buy a hedged put spread and see what the market does from there. On the shorter time frames, actually today is an example. I did 2 trades today. Greg actually North Euro FX he popped gold up there, and I looked at it and I said, okay, I've got an hourly breakout, and I gave some numbers this morning that were ridiculous on the AM call. You're not going to get a trade, $10 away either way, but I did have a trade come in on the hourly breakout, and that's why we have to be flexible intraday. And I got an hourly trade triggered on the upside. I took it, risking one to make two, and this is something that Larry does very well, and it's frowned upon on my system, but I have to do it. We got close to my two, but something looked very bad on the market from a technical point of view, and I cut my profits short. So I took like $2 out of the market in the rally, and I was right, and the market reversed. That gave me the reversal signal, and I sold that, and I took another $2 to $3 out of it on the downside. I think I spot a lot for my markets. So today was a great example of an hourly signal in gold to buy it, and then on my discretion, right? Some people put their stops in one place, but they actually act intuitively based on the fly information. But on my discretion, and I could be wrong when I do it sometimes, on my discretion, I said this did not act right when we got to 1205.80. There was a long candle wick. I got out, and then I got a negation of the direction on my signal, but a reinforcement of the volatility. So I got short. And we're probably going to continue to drop because I covered before the interview. I hope that helps.
Distracted by talking about the markets, I guess. So it's
well,
better.
The system is what it is, but I think most active traders feel they have to have their finger on the pulse, and undivided attention is important.
That makes sense. So
I mean that for the subscribers more than my trading. So I wanted to be focused.
Absolutely. And that's an important thing. Sometimes when you're distracted by the markets, you need to remind on other things. That's what you sometimes need to do. Look, there'll be a trade in the market, whether it be a few hours from now, tomorrow. It's there's always another trade. So following up on what you were just saying, you were taking me through the technical side of what you're looking at. Take me through the fundamentals of the way you look at gold and the metals.
Oh, well, okay. I think a lot has changed in gold over the years. First, let's look at it from a fear or hedging sort of thing. The perception in the past, I want to call it pre-Brexit. The perception in the past has been gold is a wealth preserver. Okay, we know the story, right? It's an inverted to the dollar because it's priced in dollars. You hedge it, you buy it to hedge dollar costs. You could buy Cadillacs, you could buy blue jeans, if they're American made. Same idea. But gold has been remonetized starting before Brexit and going through it. So what happened was, and by remonetized I mean it's de facto being remonetized, although the IMF and central banks will never admit it. But this is what happened during Brexit, and I think this is a key turning point for the metal and has made a lot of people lose money, unfortunately. In the past, Iraqi war, financial crisis, if you ever see the dollar and gold rally at the same time as a flight to safety, see dollar rally, gold rally, bonds rally, because tanks are rolling into Iraq, inevitably gold sells off because the dollar is currency. Gold may be money, but it's not a currency. So what happened with Brexit was the dollar rallied because there was a shortage of dollars and everybody wanted to get out of the euro because of the fear of Great Britain seceding from the monetary, whatever they're tied together at. It's really not fiscal, just monetary. And what happened was gold took off, and it took off like never before. And I was actually writing at the time for fun under a pseudonym, and I said, this can't last long. This is gold. Somebody's going to get the picture. And the fact is, it lasted way longer than I thought it would. And I think it created a transformation in perception of gold. And although everyone who was long realized they could not book those profits when they got out because it's like, getting out of a concert hall with only one door open, gold exit liquidity is key. What ended up happening was, because of what happened there, it went from a wealth preserver to a potential wealth creator. When you factor in the demographics in the world, in the U.S. U.S. baby boomers are older. All right, they're selling their coins. That generation is not buying coins for safety. Meanwhile, in the Far East, where you have a newly minted middle class, they're looking at gold in their currency terms, and it's going up. For them, it's a wealth creator. It's being pitched by brokers to the newly minted, bourgeoisie. Like brokers in China are saying buy rebar. I mean, really? I mean, these are crazy times if you're a broker over there, I would assume. But what happened is you went from a fear product that's a hedge against human folly to a greed product. You have a whole new generation on the Bitcoin and the FANG stocks, and gold started moving, and the algos started jumping in. And long story short, gold is now, even though it has had a 3 month downswing, gold is a wealth creator if you're actively trading it, if you're agnostic directionally, and you know what you're doing. The reality of it is algos are now in it. They extend moves. And there are three types of traders making money in gold right now. Number one, guys like Jeff Gunlock. He'll put on a 2-week to 6-month position. He'll be buying when the algos are selling at the lows, and he'll be selling at the top. The election was an example of that. The second type of trader is the shorter term trader who is playing against the algos. Algos remind me of old floor brokers. They come in at noon, they have the same order every day, you know what they're doing. Well, let them skate the market too far and then take the opposite side. They create liquidity for us. So the second type of trader would be, I guess, me, who's benefiting from the added specious liquidity that comes in and exaggerates moves. The third type of trader that's making money off of precious metals is someone who's doing what I'm doing, but from a technical point of view and looking at it from a longer term perspective. Those also include arbitrageurs, looking at things like gold-silver ratio and more esoteric things. But that's basically it. Gold has become an active trader's market, and the performance is repeatable. It's not like once in a while. Larry has been on me to be more active on shorter-term trades, and like a child, I've been fighting it because my client wants to trade 1 week to 1 month, but today, it finally sunk in, and today I put a couple trades on. I'm going to lose money doing these type of trades too, but the fact is, I have to listen to my own advice. And Larry just said to me what I already knew and wasn't doing, and
that's you got to look at whatever setups there are. You can't force things. It's whatever is out there. What are your thoughts on implied vol in gold? We've seen years ago we got up to near 2,000 in gold, and we've come straight off pretty much in a trend since then.
I feel very confident speaking about this, and I'm not infallible, but I think the more sophisticated players will grasp what I'm talking about, and you can help me get out of my own head. Gold historically for years has been a call skew market with low volatility. That's because speculators did not express their long positions with futures that much. They were undercapitalized. Gold was the last thing they put their money in, so they buy calls. Gold was a call skew market as a result, which means when the market rallied, vol should blow out and vol should drop on a sell-off, also known as stochastic volatility process. Then GLD was launched, and boom, the skew went from call skew to put skew. Now, why is that? Because domestic American investors at the fund level would buy GLD, they would buy puts and sell calls. Now, the arbitrageurs, like myself and other trading firms, would then put on fences or collars the other way, and the COMEX options volatility skew reversed, and then it went to a put skew, now bringing us up to the current day. We're back to a call skew again. And the market comes off, and vol comes in. Number one, I'll tell you why that's right, and then number two, I'll tell you why it's wrong. Wrong meaning possible opportunity. It's right because if gold has in fact become remonetized to an extent, then its volatility should be more like a currency. Back in the day, gold would trade at 5% vol when other currencies were trading at 5. So the volatility that gold experienced from Paulson buying and from Brexit, this is a hangover. The risk reward in being short gold vol is bad. On the other hand, the fact that volatility has not expanded in this move lower tells me one of two things, and I'm going to trade around it if I see what I want. Number one, it is a fact, and this is important because skew and fences and collars determine market player dominance. So if you're in the S&P, you got a put skew. Why? Because longs in stocks dominate the market. They buy puts and sell calls. That's their insurance. In gold, producers act the same way they do now as they did in the 80s. Before oil got their brains together too, they are underhedged. Gold Corp did not properly hedge, and their earnings came out, and that's a huge miss. They're a top 5 company. So now the market sells off. Most of these miners have their production cost at $1,000 or less. Gold Corp is at $850. The next move lower, perhaps the one that's happening right now, you should see, number one, the skew change towards a put skew, and then number two, volatility blow out. Right now, other miners are hedging, and perhaps other countries. Mark Fisher was spot on talking about Venezuela. But if you're Venezuela buying gold to store up your currency value, but you've got to pay your bills in dollars, well, sorry, you've got to sell your gold. And Argentina might be doing that too, and you'll hear about it on the back end. So between the miners' mismanagement, I think, of their production, and countries having to sell that which is most precious to pay their current debts, I believe that gold volatility at the money may not be undervalued, but I believe the skew should be bought on the put side. I wouldn't do that I personally, not giving advice, I personally would express that by buying a 20 delta put and hedging it. Maybe buying a 20 delta put, selling a 5 delta put, and over hedging it, because I believe the next leg lower will be an expansion in vol. But if we go higher, I want to have those extra futures against it.
Tell me this: what about the emergence of cryptocurrencies over the last 2 or 3 years? Any impact on gold?
Yeah, a lot of the gold bugs would say it's stealing investors because of how they're packaging it, and that's simply not true. And I have a chart to show you. Number one, if anything, the equity market's relentless rally is what's stealing interest from gold. And by that I mean, look at gold like you would say the VIX or a put in the S&P market. Bitcoin and its smaller brethren are a fraction of. They may be getting headlines, but that's just for search optimization for blogs that are going to be gone in 3 weeks. Bitcoin is nothing compared to the size of the volume in the stock market that has changed over the years. So my comment to that is, the headline may say Bitcoin is the new gold. It's not true, and I'd be happy to talk about that more in the chat. It's equities that are undermining people putting money in gold as the safe haven. But I believe it's an opportunity.
Everybody loves to blame the equity market for their market problems.
Well, that's because we're not long all the time.
Exactly.
Anybody who's not exactly. What's my 401k say?
All traders. The evil equities.
Exactly.
Climbing the wall of worry.
The most evil equity of all, and it's not directly to your point, but it's kind of funny. If you look at a gold miner, gold miners have a really rough time, and I'm not a fan of their management in general. You should look up what John Paulson has said recently. He's a little bit terse about it, but he's spot on. If you're an executive at a gold mine, you get paid in gold stock in the price. So you want your stock to perform, not necessarily your company, your stock to perform at a multiple of what the price of gold does higher.
Sure.
So you underhedge, right? You underhedge, and what ends up happening is not only do you have operating leverage, meaning you can scale quickly, not only do you have financial leverage, you're underhedged. So if the market goes up, it's a home run for you. If it's not, you just go to another gold company. And I think that's been a problem. But yes, I am bitter. I am not as long stocks as I should be, and I blame the equity market for everything, including my microphone problems early in this conversation.
Exactly, that makes sense. Well, on that, what you're just saying, are there any gold names that you look at that have an interesting correlation to gold, or maybe that are outperforming? And is there a reason that they're outperforming? Is there anything that kind of sticks out?
Well, I've started my beginnings on Wall Street were actually as an analyst on the equity side, working under a lunatic CFA, and I've begun looking at mines again. And what I actually paneled the New York City Mines and Money Conference recently, and I sat down with miners, and I just asked them a very simple question: "What's your hedge book look like?" And I based that on my analysis when I was trading MLPs on the natural gas side. The hedge book is extremely important. And they had no answer. We don't have any gold out of the mine, but you have assessed this gold, so why are you not hedging it? And a lot of them aren't hedging because of Ashanti. But to your point as to what stands out are the companies that aren't actually gold miners, but are proxies for gold miners. I'm not recommending stocks, okay? But if you look at companies like Silver Wheaton, and you look at companies like, I can't even think of the name right now. It starts with an F. They've had. You want to find a gold company that has a hedge book, that doesn't have direct exposure to the market, and pays its cash flow in dividends. The role of the senior miner is to buy the junior miner when he messes up. The junior miner is like an outsourced employee. The junior miner finds the gold. He's an entrepreneur, and he can't run the company to save his life. But he hopes that the senior miner buys his discovery because he's going to mismanage it. Now I've got senior miners mismanaging their own hedge book, and that's pretty scary. So yes, the miners are going to rally 200% if gold rallies. You know what? Maybe not this time. Maybe we'll find out that they've overhedged, like Ashanti and Cambior did in '99, and blow out because they can't cover their margin calls. I have no picks to give other than look at companies like Silver Wheaton. Look at gold companies actually owned by the Swiss National Bank. That's a pretty good portfolio there. I'm not going to say any names, but they can look it up themselves. I hope that helps a little bit.
Yeah, sure. All right. Well, hey, Vince, that was a lot of great information. We look forward to getting more information like that in the chat. Vince is always in the chat daily. And so, anytime something pops up, let us know, and we'll definitely be speaking soon.
That's great. There's one thing I wanted to add that I think is where the value of the team is. In the team that we have, there's a couple guys in there that will that are going to alert me to an FX pairing that should make me pay attention to gold. There's one person who alerted me on the sidelines that there's a lot of physical demand in silver at 1530, and so sure enough, I think I put a chart up with a rectangle, and sure enough, it just kept coming back. And I think in the weekly report I put out, I said the buying is there until it's not. And when the buying went away, we also had a signal to sell silver lower. Did I sell it? No. Why? Because I was too chicken. But I doubted my own information. But when you combine the kind of information we get from different disciplines, like Kai on the macro, or Greg on the FX, and those things overlap with your own system. My system is generally volatility based. Then you have a compelling reason from different angles, from a parallax sort of view, to get into a trade. We're not hugging each other going, yes, we're all bullish gold. But when Tracy says, I see this, and I say, wait, I'm getting a coiling here too, that only makes me pay attention more to if I get a signal. And that's the benefit of team, and I'm happy and grateful to be a part of it. And I hope the subscribers understand that as well.
Yeah, I think that's a good point. Absolutely. There are a lot of good minds bringing up different points and different ways of looking at the market and bringing it together. And like you said, that's something where if your own model kind of is giving you a signal and somebody else is maybe reinforcing it and providing different reasons for it, that's great value and great information. So that makes a lot of sense.
Exactly. Today's signals that I got, I probably would not have traded had I not been watching what was coming out on the FX side in our chat. I probably would have said, it's gold, in my own pessimistic way. Let me just wait until I get a really perfect signal. You can't let the good be the enemy of the great. You got to trade. And that's basically, I'm almost quoting Larry on that.
Right. Well, this week specifically, you take a look at the markets, and it's FX that's really driving things for the most part. Dollar Turkey and even euro for how that's affecting all the different markets, and so that's one of the areas where looking in the different tabs and getting insight from different people, it definitely helps all different asset classes to help guide the direction.
I mean, I think you said off the air, macro matters. And apparently it matters to everything but U.S. stocks. But we'll let Larry address that. But macro matters. Pay attention.
Yeah. All right. Well, have a good rest of the day. Thanks for taking the time.
Thank you so much. Happy to be here.
All right.